In this video, we look at how a mortgage works and why do you need one as a first-time home buyer. That's starting right now.
Welcome to Homebuyer School, brought to you by Brookfield Residential.
Hi everyone, I'm Carl. Welcome to another Homebuyer School video, a channel where you get the latest strategies, tactics, and tips from home buying experts. And remember, if this is your first time on this channel and you want to get the latest strategies from the experts, hit the subscription button below, hit the little notification bell so you don't miss anything. So today I'm joined by Mushtaba Syed, mortgage specialist with the Bank of Montreal. And today we're going to talk about actually how do mortgages work? So can you tell me a little bit more about how mortgages actually work?
So what a mortgage is a specific type of loan that you're using to purchase a home or security, like a real estate security, right? So it could be residential or it could be commercial, right? But mortgage technically is used as a loan to purchase a home. Very few people have enough money to buy a house in cash. So what you do is that you come up with a certain amount of money, which is your initial down payment, which is going to be your contribution towards the mortgage. And then you will go to a bank and they will come up with the remainder, right? So they will lend you that amount depending on how much you qualify for, so you can go ahead and buy that home. They will now put a lien on that property till you have paid off. Now your term could be 5 years, and your amortization, which is the life of the loan. So clients always ask me, what is an amortization? Amortization means the life of the loan. So obviously 25 years would be a life of a loan, which means that your payments are kind of spread out over 25 years because it'd be very difficult for you and be very hard if you had to pay it off sooner. So they would actually go over a certain life of the mortgage, which is 25 years. Rates are actually based on terms. So terms are anywhere between 6 months all the way up to 10 years. Most Canadians will go with a 5-year term because they feel like 5 years is the longest time that they want to commit to a certain home or to a certain lender, and rates are pretty decent. So let's say your rates are based on a 5-year term of a 5-year increment that you decided to stay with this bank for at a certain rate that you're willing to pay them back based on what they've lent to you, and over an amortization or a life of a loan over 25 years. So a mortgage is, in a nutshell, a loan that you get to buy a home that a lender would provide to you.
Does it have to actually be a mortgage? Like, can I just go to the bank and say, hey, I need to borrow $150,000? And they ask you why, and you're like, well, it doesn't matter because I just need to borrow $50,000, right?
It definitely matters. Every time you go into a bank and you ask for borrowing or you have some borrowing needs, they're going to ask you what you need those funds for, right? So every process with the bank when they're borrowing something has different needs, right? So it will be looking at using it for different purposes, and then we might have different collateral needs for that. We might have different qualifying needs for that, different income requirements. So the bank will walk you through that. So it definitely does matter. So if you're going to borrow for a mortgage, the bank will tell you it's for a mortgage, and then you have to actually provide to them what they need to get it approved.
So when you mentioned a lien, what does that mean?
So a lien just means that this thing is not free and clear. Let's use a home, for example. Let's say you pull a title of a home. A title is like a deed of ownership, right? And you see there's a lien on it for like $350,000 with, let's say, Bank A. That means that of this home, $350,000 belongs to Bank A till you pay that $350,000 off or till they release their lien. If you want to be able to buy that home, you're a buyer and the seller provides you a title with $350,000. You want to make sure that this lien is off this property before you can buy it. Anyone that holds the lien on that property can actually claim ownership of that property if he refuses to pay. So it's a very, very important thing, right? So this is how banks protect their funds, their investment into a home, into a car, into any other assets they're lending onto. Is to say, we lend X amount of dollars, we own X amount of this property till it gets paid off.
And that's kind of what it means when someone forecloses on a mortgage.
Yeah.
They can't afford to pay the mortgage anymore, which means they will probably have to leave the house, right?
Yeah, so usually if you can't afford to pay a home, the bank will absolutely try to work with you in the beginning to see what they can do. But unfortunately, let's say you can't pay it back, there's a lien on the home with Bank A. Bank A will definitely take that home, right? And it will try to recuperate any funds that they have lent by, let's say, putting it up for sale, putting it up for auction, whatever it is, so they can recuperate some of that cost, right? So that is what goes into a foreclosure process.
So let's say you buy a house for $350,000, right? And you take out, you only pay a 5% down payment, and you borrow the rest. What happens when you sell that home and buy a new home? Does your mortgage transfer over, or do you have to get a brand new mortgage?
A lot of mortgages have, let's say, terms and conditions. Terms and conditions are very, very important, right? Now, most mortgages have a term built in, which is called portability. where you can actually port your mortgage from one property to another as long as you qualify to do so. You still have to go through the qualification process. A lot of my clients ask me and said, I qualified 5 years ago, why do I need to go qualify again if I'm just moving the mortgage over? Is because every time we do that, we need to see if the situation has changed. It does go through the approval process like a brand new mortgage. We will appraise the property again or do our due diligence on the property again to make sure it fits our criteria again. But what it does, it saves you from any penalties, right? So let's say you're on a term of 5 years, you decide to sell before that 5-year term is up, there's going to be, you've signed a contract with the bank to be there for 5 years, there's going to be some penalties incurred. But you can't port your mortgage onto a new property. Some banks will give you 30, 60, 90 days, maybe 120 days to do that, depending on the lender. So that by the time you sell, you have a certain amount of time to find a new property. You can save yourself those penalties. So you're not locked into a home for too long. But every mortgage should have a portability option built into it.
And how about if the home that you're buying is significantly more or significantly less than what your previous home is? Does that portability still take into account the price of the home that you're buying?
Yeah, absolutely. So let's say scenario one is you're buying a home that is more than what you previously had. So you bought a home for $400,000. The mortgage amount is $350,000, but now you're looking to borrow $650,000, right? There's a $300,000 difference. Let's say you have interest rate of 3% on the $350,000, and you needed to borrow another $300,000, and today's rates were at 3.5%, for example. What the bank would do is that would make it into one mortgage of $650,000, and they would do a blend of the rates. So a blend 3% with 3.5, so you fall right into the middle, and then you will have one mortgage based on that. You still get to save your penalty. You still get to save any other costs that might be associated in paying it out sooner, and you get the one mortgage. Scenario B, let's say you're buying something which is considerably less than what you originally had. Example is $200,000. $200,000 is your mortgage, and you're buying something for $100,000, right? So you sell your home, you borrow for $100,000. You will pay a payout penalty on the amount that you're not borrowing, which is going to be the $100,000, which is still going to be a significantly less penalty than the whole amount, but you will pay a penalty on the amount that you're not borrowing, and you just take a decreased amount at whatever the interest rate that you had up to $200,000. There won't be any blending at that time because there's no greater value to be added to the mortgage. It's actually just decreasing the mortgage by that amount.
Do you also pay a penalty for a home that's more expensive as well?
You won't pay a penalty if you don't break your term, right? If you keep your term on the mortgage amount, let's say it's $350,000. Let's say that $350,000, there's no changes to that. There's no penalty incurred. We could do a blend and an extend if you're buying a property worth more, but there will be no penalties incurred to do that unless you decide you want to break that original agreement of $350,000, and then the penalty will be based on the scenario. If you're taking less, if you're not taking any of it, the penalty will be based on that.
Perfect. Do you have anything else to add?
Definitely. So penalties, they're a touchy subject, right? When it comes to clients and with the banks, it's something that a lot of clients don't understand because there's two ways to calculate a penalty. One is called just 3 months interest, right? So depending on what kind of mortgage you have, you can be charged 3 months interest, or something called IRD, which is called interest rate differential. I'm not going to go into it a little bit too much because it's a very complicated process. So the best thing to do is that if you're looking at selling your home, right? Or if you're looking at, when you said at the time that you're finding a bank, you want to go through their terms and agreements, find out with them to see how they calculate penalties, right? That could be a very big thing because you might not want to be in that home as long as you might think. So you want to do this due diligence up front to find out, if I do leave sooner, what kind of penalties am I looking at? And let the lender come up to you and say, listen, these are the numbers that we're talking about. It could be in this range and this range. If you're comfortable with that, great. If not, maybe reassess your situation. Maybe even reassess if you want to be in that house longer and maybe take a shorter term. Instead of going for a 5-year term, you want to leave in 2, maybe go for a 2-year term, right? Maybe go for a 1-year term. So those are conversations you want to have in the beginning, right? No one enjoys paying a penalty. I certainly don't.
Perfect. Well, thank you very much for watching. So if you want to know more about the mortgage approval process, we've got a great video series here, as well as other home financing videos that you can see here. Don't forget to subscribe to keep hearing from the experts, and we'll catch you in our next video.